Buying a home in Canada is one of the biggest financial decisions that you could ever make. But here's the reality: most Canadians don't fully understand how mortgages work. And the lack of knowledge, it's costing Canadians tens of thousands of dollars every single year. Today, we're going to fix that. In this video, I'm going to walk you through the absolute basics of mortgages in Canada, the terms you need to know, the mistakes to avoid, and the decisions that could make or break your financial future. Whether you're a first-time homebuyer or someone thinking about upgrading, I promise you'll leave this video with clarity and confidence. Now, quick disclosure, I'm a mortgage broker here in Ontario, but this isn't a sales pitch. I've seen too many Canadians get burned, not because they can't afford a house, but because they didn't understand the rules of the game. So think of me as your translator. I'll break down the complicated mortgage jargon and show you exactly what matters, what doesn't, and how you can use this knowledge to make smarter decisions. Housing affordability in Canada is a hot topic. Prices have been climbing for decades, interest rates bounce around like roller coasters, and for many people, the idea of buying a home feels overwhelming. But here's the truth: understanding mortgages is key to unlocking home ownership. It's a tool that allows everyday Canadians to build wealth through real estate. Statistics Canada show the average net worth of a renter at retirement is around $29,000. The average homeowner, about $1 million. That's the difference between stress and security. So here's the roadmap. We'll cover what a mortgage actually is. We'll explain key terms like amortization and term. We'll dive into fixed versus variable, mortgage insurance, pre-approvals, and the hidden traps banks don't warn you about. So let's start at square one. What is a mortgage? At its core, it's just a loan secured against real estate. You borrow money and you agree to pay it back over time. So why do mortgages matter? Because very few people can actually save hundreds of thousands of dollars in cash. Mortgages make home ownership possible. And unlike most debt, a mortgage can actually help you build wealth. But here's the tricky part: mortgages aren't all the same. The banks may offer you one type of product, but it could come with massive penalties and restrictions. If you don't know what you're signing, you could get trapped. So before you start house hunting, you need to understand the language of mortgages. Otherwise, you're stepping into one of the most important financial contracts of your life. In the next part of this video, we'll break down the most important mortgage terms and concepts in Canada. We'll talk about fixed versus variable rates, amortization versus term, prepayments, penalties, insurance, pre-approvals, and different lenders. This is where the banks make their money, and this is where you need to be smart. So let's dive in. Let's start with the classic question: fixed or variable? A fixed rate mortgage means your payment stays the same for your entire term. It's predictable, safe, and you can budget around it. But you often pay more for that uncertainty. A variable rate mortgage changes whenever the Bank of Canada moves interest rates. Sometimes your payments change, sometimes just the balance between interest and principal changes. There are two types of variable rate mortgages: adjustable payments, where your payments move with rates. And then there's fixed payment variables, where your payment stays the same, but the portion going towards interest shifts behind the scenes. So which is better? Adjustable often makes more sense. You consistently pay down your principal. Fixed payment variables can mask problems until renewal. For example, a $500,000 mortgage fixed at 5.5% for 5 years. That gives you certainty. But if the Bank of Canada drops rates, variable borrowers benefit instantly. Now let's clear up amortization versus term. Amortization is the total lifetime of your mortgage, usually 25 or 30 years. Term is the shorter contract window. Most Canadians choose 5-year terms. People often say, I have a 5-year mortgage. No, you have a 25 or 30-year mortgage with a 5-year term. And that distinction matters. Next, principal and prepayments. The principal is simply the amount you borrowed. Early on, most of the payment goes towards interest, and later it goes towards principal. Prepayment privileges are built into most mortgages. You'll see terms like 15-15 or 20-20. That means that you can increase your regular payments or make lump sum payments up to 15 or 20% each year without penalties. Using these smartly can shave years off of your mortgage, but don't empty your savings account to do this. Once that money goes into your mortgage, it's hard to get it back. Always keep some cash aside for emergencies. Now let's talk about open terms versus closed term mortgages. Open means you can pay off anytime, no penalty, but you pay a higher rate. Closed means lower rate, but penalties if you break early before the end of the term. For most Canadians, closed makes the most sense. Now, penalties. There's three main types: 3 months interest penalty, an interest rate differential or IRD, a flat fee, which is more common in private or B lender mortgages. IRDs can be brutal. If you lock in at 5.5% and today's rate is 4%, the bank charges you the difference times the times left. I've seen penalties over $35,000. That's why I use the 3P rule: product first, penalty second, price last. If you shop on rate alone, you risk saving a fraction of a percent, but paying tens of thousands of dollars later. Mortgage insurance is next. If you put less than 20% down, it's mandatory. It protects the lender, not you. The premium gets added onto your mortgage. The good news, it reduces the lender's risk, so you usually get a lower interest rate. The bad news, it adds thousands of dollars to your total cost. Aim for 20% down if you can, but if not, don't panic. It's simply the cost of getting into the market sooner. Now let's talk about pre-approvals. A real pre-approval means that you've submitted documents and you had your credit checked. If you haven't provided paperwork, you're not pre-approved, you're pre-qualified. And a pre-qualification is basically worthless. Don't fall into the trap of shopping without a proper pre-approval. It will protect you from heartbreak later on. Finally, choosing a lender. Big banks have the brand name, but often the harshest penalties. Non-bank lenders like First National or MCAP may not be a household name, but they often have better products. Credit unions can be good locally, but portability is limited. So the bottom line, don't just default to your everyday bank. Compare your options. Sometimes the best mortgage comes from a lender that you've never heard of. So that's the nuts and bolts: fixed versus variable, amortization versus term, prepayments, open versus closed, penalties, insurance, pre-approvals, and lenders. This is where Canadians either save thousands or lose thousands. Now let's apply this knowledge. I'll show you how to buy smart, budget wisely, and set yourself up for success. So let's bring this all home. Mortgages aren't just about chasing the lowest rate. They're about understanding the rules so that you can play smarter than the bank. So let's recap what we've talked about. A mortgage is a loan. Fixed versus variable is certainty versus flexibility. Amortization versus term is the lifetime versus the contract. Penalties can be brutal if you don't understand them. Insurance is required with less than 20% down. Pre-approvals with documents is essential. And not all lenders are created equal. So if you're thinking about getting a mortgage or buying a home, get a pre-approval. That's the budget guardrail. Step 2, know your numbers. Mortgage payments isn't just the only cost. You need to budget for property taxes, utilities, insurance, and maintenance. Keep housing costs under 35% of your gross income. Step number 3, if you're upgrading, get your current home ready to sell. Only the homes that are priced right, maintained, and presented well are moving in this market. And remember, buying a home is emotional, but don't let emotion make the math disappear. A home should be a blessing and not a burden. Build the right team. Get the right realtor, mortgage expert, and lawyer. The right team makes the process smoother and less stressful. Long-term, your mortgage isn't just debt, it's a tool. Every payment builds equity. That equity gives you options to refinance, invest, or move up down the road. That's how generations of Canadians have built wealth. So don't be passive. Ask questions, compare products, use the 3P rule. Make your mortgage fit your life, not the other way around. If this is helpful, like this video, subscribe, and drop a question in the comments. Check the links in the description for tools and resources. Buying a home in Canada doesn't have to be stressful. With the right knowledge, the right team, and the right mindset, it can be one of the best decisions of your life. Thanks for watching, and I'll see you in the next video.